Welcome to Dhansetu. Today are going to discuss India's economic crisis, rupee fall, market crash, and FII outflow.
Since the outbreak of the Iran war, the Indian stock market has hemorrhaged between 51 and 57 lakh crore in total market capitalization. To put that into perspective, investors have watched roughly 17 to 20% of India's entire gross domestic product simply vanish. Because of this massive contraction, India's standing as the fourth largest economy in the world has slipped, dropping the nation down to sixth place. If you ask policymakers why this is happening, you will usually hear the same explanation. They point to global instability, specifically highlighting the fact that crude oil prices are sitting above $80 a barrel. This chart shows the percentage of oil imported by 3 neighboring countries. India relies on foreign sources for 88% of its oil. Pakistan sits right next door at 83%, and Bangladesh imports a massive 96 to 97% of its supply. All 3 economies are heavily exposed to the exact same oil price shocks. Yet, over the last 2.5 years, the Indian rupee has plummeted 22% in value against the Pakistani rupee. Against the Bangladeshi taka, the Indian currency has dropped roughly 10% in the past year alone. If global oil prices were the true culprit, all 3 currencies would be suffering equally. But the data points to a different reality. A hidden internal drain is stripping away India's economic momentum. The actual pressure comes from a massive, historic reversal in foreign direct investment. The system is rapidly pulling US dollars out of the Indian market. This chart tracks net FDI inflows into India. In 2020 and 2021, the country was a highly attractive destination, successfully pulling in roughly $43 to $44 billion in net investments. But watch what happens next. By 2023, that number crashed to a mere $10 billion. The current projections for 2024 through 2026 show the trend completely inverting. India is facing a massive negative outflow of $35 to $40 billion. Much of this outflow is driven by early foreign investors who entered the market years ago and are now cashing out their gains. According to the RBI, this rise in repatriation is a sign that these investors have achieved their targets and are moving their capital to other emerging markets where the growth cycle is just beginning. Domestic companies are also packing up. Indian firms are actively offshoring their own capital to places like the UAE and Switzerland to access friendlier tax regimes and lighter regulatory frameworks, often routing the money through financial channels like Gift City. Add to that the pressure of changing global trade policies. Looming U.S. tariffs are forcing Indian pharma and manufacturing firms to physically build their new factories overseas to maintain market access rather than expanding at home. The Reserve Bank of India is trying to apply a tourniquet. They are currently running $5 billion rupee swap auctions, which is essentially a way to artificially buy dollars back from commercial banks to prop up the country's depleted foreign exchange reserves. These are short-term maneuvers. Until the government heavily reforms market access and cuts corporate red tape, interventions will not stop the structural bleeding of capital. For the retail investor, this capital flight represents a persistent headwind. When billions in foreign currency leave the system, the liquidity that once supported record highs is replaced by the potential for sudden, sharp swings. The first line of defense is building a fixed return cushion. At a bare minimum, 10% of your overall portfolio must be shielded in fixed return assets to absorb the worst of these incoming market shocks. Recurring deposits, or RDs, are highly effective for this. They force financial discipline by automatically locking away a small portion of your monthly income before you can spend or risk it elsewhere. You can execute this through platforms like StableMoney, which allows you to compare rates across more than 200 banks. You can lock in top interest rates, currently sitting around 8.1%, without the friction of opening dozens of new separate bank accounts. The second critical rule is to stop panic selling. During deep market corrections, amateur investors frequently liquidate their mutual funds at exactly the wrong moment. This chart models a popular mid-cap mutual fund. Its value suffered a brutal 29% drop, pushing investors into a red panic sell zone. But then it rebounded sharply. Sellers locked in losses, while investors who held regained their wealth. Weathering this economic cycle requires focusing on the variables you can control. By layering in fixed returns and resisting the urge to sell during a dip, You turn a period of national economic stress into a test of individual patience.
Subscribe to Dhansetu and stay ahead in the world of finance, investing, and wealth creation.